Good morning, ladies and gentlemen, and welcome to today's keynote address from the head of Australia's inquiry into the financial system, David Murray. I'm Jared Martin, Australian bank analyst at Credit Suisse. It's been nearly 17 years since the last major investigation into the Australian financial system. Then, the Wallace inquiry identified inefficiencies in the financial services sector, resulting in an extensive legislative and regulatory reform agenda. All eyes are again on what has been dubbed Son of Wallace, and David Murray, who is leading this latest inquiry into Australia's financial system. With the power to trigger big changes in a sector that plays an unparalleled role in the economy, David's perspective on the inquiry's scope and possible solutions will be of significant interest. And with collective annual profits in excess of $27 billion amongst Australia's four major banks alone in 2013, the stakes of any policy changes will be high. For those of you not familiar with it, this inquiry is charged with examining how the financial system could be positioned to best meet Australia's evolving needs and support Australia's economic growth. It will make recommendations to foster an efficient, competitive and flexible financial system consistent with financial stability, prudence, public confidence and the capacity to meet the needs of users. Given his impressive and extensive career in financial services, David is extremely well qualified for the task at hand. David joined the Commonwealth Bank back in 1966, was appointed Chief Executive Officer in 1992 and retired in 2005. His 13 years as Chief Executive of CBA, during that time it was transformed into a $50 billion financial services company and now rates as one of the top 10 banks globally. On his retirement from CBA, the Australian government appointed Mr Murray as Chairman of the Future Fund, responsible for investing budget surpluses to meet the long-term pension liabilities of government employees. After his term on the Future Fund ended in 2012, David joined Credit Suisse as Senior Advisor, a role he relinquished after being tasked with leading the inquiry at the end of 2013. He has served as a member of the Financial Sector Advisory Council, Chair of the International Forum of Sovereign Wealth Funds, and he was made Officer in the Order of Australia in 2007. Please join me in welcoming David Murray to the AIC.
Well, Jared, thank you very much for your generous introduction, and I enjoyed your reference to the level of profits of the banks in Australia, and I'm sorry to those who criticise banks for playing such a role in driving those profits higher. But it's not a bad thing for stability either, is it? In Australia, there have been two previous major reviews of the financial system. The Campbell report reported in 1982, and it was tasked with designing the framework of a financial system in an economy that had been further opened up and deregulated, but had a financial system that was highly regulated. And Campbell set a blueprint for some considerable time. The Wallace Committee published its final recommendation 16 years ago. It was tasked with understanding, or at least recommending, the best way to regulate the financial system, given the build-up of risk in the corporate real estate market in the 1980s and some banking problems that emerged in the early 1990s. And the recommendations of the Wallace inquiry set the framework of regulation that we still have today. The intervening years since the Wallace report have seen some major changes in the financial system, some of which have been unforeseen. The economy has expanded consistently for more than 2 decades. We now have 22 years of continuous growth, and the terms of trade have been at their highest level in over 50 years. Globally, there's been a shift of economic weight to emerging economies in Asia, and their share of world GDP has increased 12 percentage points since 1997, and now account for at least a quarter of world GDP. Within Australia, since the last review, we've seen a substantial increase in household indebtedness, a noticeable rise in Australia's net foreign liabilities, and more recently some deleveraging by the corporate sector, and for the government, a net financial position going from being out of debt to being back in debt. These changes serve to remind us how much we rely on the financial system to continually adapt to changing patterns of funds flows and of the fundamental importance of that system to the Australian economy. Through this time span, the Australian system has undergone some significant changes. Some, of course, were a product of the global financial crisis. For example, one of the key tenets of the Wallace Report was that the Australian government should not guarantee financial institutions. So we would not have predicted before 2008 that the Australian government would have to guarantee Australian bank deposits and wholesale funding. Some of the other, as a consequence of the crisis, some of the other changes we've seen in the intervening years have been slower in coming about, yet they still have significant implications for the way that the system operates. The annual growth in financial assets of Australian governments, businesses and households has averaged 9% since 1996. Growth in banks' holding of financial assets has averaged nearly 11% over the same period. And during that period, growth of nominal GDP has been about 6.5%. We've also seen rapid growth of superannuation funds, especially self-managed funds. As at June 2013, superannuation assets total 1.6 trillion, about the same size as GDP, with a compound annual growth rate of 12% since 1996. And of this amount, 506 billion was in self-managed super funds, which with an average compound growth rate of 19% since 1996. Some of these trends, of course, were becoming apparent at the time of the Wallace inquiry, but the passing of time has emphasised their significance for the overall system. So a key challenge for the Committee of Inquiry will be to evaluate these impacts and identify major drivers that will shape the system and its contribution to the economy in the foreseeable future. Just to help understand how we'll go about this, I want to explain the context for the inquiry, give some examples of some major issues, and lastly address developments in the Asian financial system and its relationship with Australia. In relation to the context for the inquiry, the Treasurer in opposition proposed this in October 2010 as part of his intention to reform banking policy. This was prompted by some concerns about competition when bank interest rates changed out of step with changes in the official cash rate after the crisis. But it also reflected more general concerns about the legacy of the crisis itself. As the Treasurer has since noted, experience during that crisis challenged some of the key assumptions underlying the Wallace Report. One of them included the assumption that failure of a financial institution is a normal part of market-based system and that governments should not guarantee them. While this may have been undermined to some degree by the government's response to the collapse of HIH insurance many years ago, the financial crisis highlighted the difficulty of applying this principle and the extent to which taxpayers effectively underwrote the stability of the financial system. Other assumptions were also undermined by the crisis. For example, it had been implicitly assumed that crises and failures were more likely to emanate from within Australia rather than externally. It had also been assumed that markets are self-equilibrating and less prone to failure than individual institutions. One legacy of the crisis has been to question these assumptions, although it is not clear we've landed on viable alternative positions. Another legacy has been the global wave of regulatory change with significant impacts for Australia. For example, we've revised our own standards in some areas to reflect global standards, for example, Basel III. We've had to adjust to major regulatory changes in Europe and the United States, both of whom have become much more emphatic in asserting their jurisdiction over foreign market participants. And we've witnessed long-term structural changes in the global economy and financial system, including a shift to emerging economies in the Asia-Pacific region. The effects of the crisis were felt by many Australian retail investors who suffered substantial losses associated with the failure of financial firms or mis-selling of financial products. These consequences have called into question whether disclosure is effective. So it's against this background that the government has asked the inquiry to do four main things. First, work out how the system has changed since the Wallace inquiry, including the effects of the global financial crisis. Second, to consider what developments since 1997 mean for Australia's regulatory philosophy. For example, do we still believe that the government should not intervene to guarantee financial institutions? If not, what do we now believe? Thirdly, we've been asked to identify the likely drivers that will shape the system over the next significant period and assess their implications. We know it's notoriously difficult and somewhat flawed to make economic forecasts. However, it should be possible to assess the potential implications of some different scenarios. So in that context, we'll be looking at scenarios in the Australian economy and risks to the economy in different scenarios and how the regulatory structure might respond. The fourth thing we've been asked to do is to develop policy recommendations to ensure the financial system builds on its strengths and remains appropriate for the economy. In this regard, we're keen to ensure we have a system that balances competition, innovation, efficiency, stability and consumer interests and meets the country's needs from the perspective of both end users and the financial institutions themselves. I mention all this context to emphasise the importance of the inquiry in developing a policy blueprint for the Australian financial system in a post-GFC world. This blueprint needs to take account of the broader role and many interdependencies in the system, which explains why a broad terms of reference is both necessary and valuable. So overall, we want to make sure that the financial system is fit for purpose to promote growth and productivity in the Australian economy over the foreseeable future. Inevitably, and particularly with submissions due next week, there'll be many themes that we'll need to consider, but I'd just like to highlight three. The first is the funding of the economy itself. One view is that the economy, one way or another, will get funded, and that another view is that there may be circumstances where funding of the economy may be at risk, with issues of contagion and loss of confidence potentially causing structural damage to the economy. Irrespective of which view you take, what matters is the quality of the funding of the economy. In this regard, the committee will be interested in the efficiency of the system and how it can improve productivity overall. Equally and more importantly, we'll be interested in the allocative efficiency of the financial system in funding the economy. We'll be interested in how well the economy funds small and large businesses, households, governments, agriculture, industry, infrastructure, and new and developing ventures, and whether whether there are any distortions in the system that favours the funding of some users or providers of capital over others. We'll be interested in the dynamic efficiency of the system. In other words, is the system continuously adapting to new types of claims and obligations better suited to the issuers and holders of financial securities? There has been discussion for some time over the development of Australia's bond markets, venture capital markets and mechanisms for infrastructure funding. Also, there's been interesting innovations in the not-for-profit sector, such as social bonds. One aspect of this issue is the growth of superannuation funds. The manner in which these funds are invested is very important to the questions of allocative and dynamic efficiency. In Australia, the superannuation funds represent, as I said before, about the size of GDP, and so do assets in the banking system. In considering these issues, we have to balance stability, competition and efficiency objectives. And the second theme I want to mention is the state of competition in banking, payments, insurance, funds management and financial markets, and whether it drives or impedes efficiency in the system. A key issue in this area will be the impact of regulation on competition, including whether firms face a level playing field. Moreover, regulation can promote competition, for example, by helping consumers make more informed decisions. However, it can also create barriers to entry and increase compliance costs with varying outcomes for financial institutions of different sizes. In the wake of the financial crisis, it's not surprising that the focus of regulators and global standard setters has been more on stability than competition. Accordingly, we'll be very interested to examine the extent to which stability objectives might hinder competition, or even perhaps in some cases promote more competition and reduce systemic risks. One particular matter I want to mention is on competition and efficiency is technology. Much of the work that institutions in the financial system do involves, quite simply, the keeping of books and passing of messages. That's not how the system creates value, but that's what you do to create value. It should not be surprising then that the development of computing and communications technologies in recent history should have such a profound effect on the system. We should bear in mind that these developments form one of the greatest generally applicable technological changes that we have seen, and is still only working through all aspects of industry. Some of the more obvious impacts involve high volume payments, trading and settlement systems, but they also involve the development of the management of large volumes of data, which actually enhances risk management in financial institutions. But it carries some interesting new developments, particularly in areas of e-payments, e-currencies, and the very business models that people can adapt to form shadow financial systems, and the pressure that creates on stability for regulators to consider whether those models should be brought inside the regulatory perimeter or stay outside it. One particular issue for us is cybersecurity and the prudential risk that can carry. I just want to move on to developments in the Asian financial system. Many years ago, I worked on the APEC Business Advisory Council in the wake of the Asian financial crisis, and the representative from here at the time was Victor Fung. We tried to work out what Asian financial systems had to do to increase their depth and be more resistant to the sort of things that happened in 1997. Interestingly, Victor has formed the Fung Global Institute, and together with Oliver Wyman, the Institute published Asia Finance 2020 recently and set out a number of proposals for development of Asian financial systems. The president of that institute, Andrew Sheng, I'm pleased to say, has been appointed by the Treasurer to an international advisory panel that will help the committee do its work. And Michael Hinz is here today, another one of our members, our advisory panel. Just a few points that the Fung Global Institute has made. As I mentioned before, in the last decade or so, Asia has significantly increased to 31% its share of global GDP, but the financial sector is not yet suited to serving the transformation of Asian economies. For example, more developed economies have a depth ratio of 4 to 5 times GDP. China and India have a depth ratio of just over 2 times GDP. Korea and Thailand just over 3 times. So there is a lot of deepening that can happen, and with that, an amazing growth potential of the financial sector in Asia itself, with very significant opportunities for investors. The Institute also mentioned the need to deepen the system by reducing the relative weights of bank funding and increasing the relative weights of capital market activity, and particularly through the presence of long-term investors, insurance funds and pension funds. They point out that the efficiency benefit of an integrated financial sector would raise GDP in the region by 0.5 percentage point year on year continually, and would increase financial system market capitalisation by $2 trillion. So this is a very worthwhile target from an investment perspective. It's even more worthwhile for the health of the economies in the region themselves. But the Institute expressed a cautionary note in relation to Basel III. They point out that in certain products relating to SME lending, trade finance and infrastructure, there will be disadvantages in the Basel III system. They say, quite rightly, that this is not clearly evident yet because the US dollar liquidity consequences of quantitative easing mask the problem. But it will become more evident. It's been partly evident in trade finance already, but it will become more evident as that situation changes, inevitably changes. So some countries are already delaying implementation of Basel III, and the Institute points out that Asia should keep an eye on the product effects of Basel III and understand some of the deficiencies going forward. For Australia, with a financial depth of over 4.5 times GDP, an economic growth rate that will be higher than Europe and the United States, lower than the Asian region, but more of a derivative of the Asian region, it's very important that our financial system is rigged, of course, with stability, but to serve a growth of the Australian economy as a key participant in Asian growth. And it will be very important that we uncover ways in which the Australian financial system and the Australian government can play a role in efforts to accelerate integration integration and deepening of Asian financial systems themselves. So I'm hoping, on behalf of progress in the region, on whom we are significantly dependent for trade, that the financial system inquiry can play its role in helping with these developments, and at the same time, of course, helping to promote the growth and productivity of the Australian economy. We look forward to the submissions that we're going to get next week, and we look forward to making some robust recommendations to the Treasurer after our interim report in mid-year, in our final report in November. So thank you for having me here today, and I welcome any questions.
I have about 25 minutes for Q&A. If you'd like to raise your hand and just wait until a microphone is brought towards you, and we'll kick off just here.
Thank you, David. In light of Dr. Evans' speech before, he made the point that the US system could be too big and too complex. In the context of Australia, the Productivity Commission came out and said, because of our compulsory superannuation system, there could have been a misallocation of resources, and our system may be too big. Do you have any comments on that?
Well, it's an important issue. I recall when I was managing the Commonwealth Bank, I never thought getting too big would be a problem. I'm a bit of a fan of growth. But if you look at those ratios on financial depth, areas which are a financial hub have huge ratios. I think 7 times in UK, 12 times in Hong Kong, a large number in Singapore. They have particular complexity of prudential regulation to cover contagion within their own system. That's not the case in Australia. I think the more interesting issue for us is that the superannuation system allocates assets in a way that can favour some over others. And if we look at the dynamic development of the economy, of the financial system, many are asking why we don't have a corporate bond market of much larger, why our venture capital system in an otherwise advanced system is not more, shall I say, flamboyant, energetic. And so they're just a couple of examples. There's always the issue of SME lending, SME financing, and of course developments in infrastructure. They're just a few examples of things that we need to chase down and see why the allocation works the way it does and whether it is the best outcome. In doing that, we're simply trying to promote a financial system in which the holders of securities, for their own purposes, have the broadest range of securities available to them possible. At the same time, the issuers of securities, often, commonly the business sector, has the broadest range of securities available to issue, depending upon the maturity, the horizon in their business, the nature of their fixed capital, and so on. We just see that as being an enormously efficient system to promote growth in the economy.
Good morning, Mr. Murray. Thank you very much for your presentation, very insightful. I have a question with regard to financial behavior. I'm currently looking into several business opportunity in the Australian market, and all my local friends in Australia seem to look at Australia much more pessimistic than we from the outside. Are we more stupid or more naive as outsiders, and do they have better database than we tend to have?
It might be too many of my Irish friends in the Australian system, but I think that the issue here is that Australia has a very small population relative to its land mass and natural endowments. We have about 26 million population, the US close to 300. And the land mass of Australia is the same size as mainland United States. We have 5% of the global land mass and 0.3% of the global population. Now, if you have those characteristics and a competitive advantage in commodity supply, you have the combination of a relatively small economy and ultimately always a price taker for commodities, and so some volatility that goes with that. What this means when I mentioned 50-year high terms of trade, what this does is to quickly exhaust the capacity utilisation in the economy. but we have a modern market economy with a modern central bank who has been really outstanding in the conduct of its monetary policy. The consequence of that is they don't make mistakes and they pull the handbrake on the economy very quickly when the terms of trade move as they did. So what we see now is an economy where the construction phase of that terms of trade boom is tapering off. The cost structure that has been created by that boom has been elevated significantly. With 22 years of continuous growth, some element of complacency in business that doesn't drive as hard as it might on issues of industrial efficiency, industrial relations activity, and so on. So, and over the last 6 years in particular, we've seen an enormous increase by government on social infrastructure, welfare spending. The combination of all these things gives rise to concern about productivity. And so, because we have a budget in deficit now, some government debt and productivity weakness. So I think those in Australia that are pessimistic are very keen to see a significant economic reform program to sort that out. That's why the government's mantra, the new government's mantra, is open for business and has a significant deregulatory intention in the way it will go about its work. And so we're on a bit of an edge trying to figure out whether this will be successful or not, or whether it'll get more difficult. I think that's why that nervousness exists. Looking from the outside, in the Asian region, a country which has such an open market economy, a well-traded currency, a currency that's never been attacked because of the strength of macro management and the Reserve Bank's capabilities, and a AAA rating of its central government, people look at that and say, well, it's just completely obvious that amongst all my investment choices, I would invest there because that's what a good financial system in Asia should do. I hope that helps.
Thank you for your very good presentation. I was interested in your comments about Wallace saying there should be no guarantees for institutions. It seems now, if you look at market pricing, that there's quite a strong implicit guarantee of the major Australian banks. Do you see that as a significant issue? And if so, what could be done about it?
Yeah, the quandary for us here is that one consequence of the crisis is that governments are pretty much expected to guarantee everything. And that means that, you know, the jury on moral hazard has deliberated against the taxpayer. That's just a consequence of a crisis. Many look at this system and say, and the rating agencies have all of a sudden changed their model and calibrated a precise amount for this implicit guarantee, which they did not do before. So I'm very interested, and any help anybody can give me will be welcome, in understanding whether this is logical or not. If there's an implicit guarantee of banks in the system, there is an implicit contingent liability on government. And given that the banking system, and with contagion, I'm not sure you can limit it to major banks. The banking system is the same size as GDP, so that's a large contingent implicit liability. Why didn't the rating agency take the rating off the government instead of putting it, you know, putting it on the banks? And I think if you look at market implied ratings, you might get a different picture. Also, in our approach, we're keen to explore what is just a natural industrial outcome. As a bank succeeds, it is likely, as in any industry, that will become increasingly successful because of scale economies, particularly now with technology in banking, more so than in the old branch banking structure. That is, in a sense, welcome, that somebody would grow because their customers like dealing with them and they would reduce their unit costs. At the same time, they become more creditworthy and reduce their funding costs. That happens in all industries. So we've got to be careful what is natural and what is different. And in that regard, we also want to look at issues of consumer protection and so on, and ask, is disclosure and information asymmetry really any different in this system to, you know, somebody who has a warranty on a car and has never read all the fine print? So that's the approach we're taking, and I'll remain pretty keen to see where we fall on that implicit guarantee issue.
David, with your experience with the Future Fund, I think it's had a pretty good outcome, and it's done well for, you know, funding public servants going forward. Is there a possibility we can extend that model for funding of like the old age pension and for the rest of the workforce, and maybe have some defined outcome in that process, maybe more like the Canadian system? But I said it seemed to be quite successful, what you've done for the public servants, and there's probably some political issues around that, but
yeah,
seems a reasonably good model.
Yeah, well, the model you speak of is in fact the New Zealand model, where a defined amount of, a defined component of the budget goes every year into their future fund. And they, under their model, they set out to get about inflation and 4 over the long term to fund public pensions. It doesn't make it a defined contribution system, it just funds the pensions and takes pressure over the long term off the budget. Now, I'm an accountant by trade, so you've got to have both sides of a balance sheet, and it's got to balance when you're finished. And you've got to know where to put the difference, because there's always one. But the same thing applies here. If a government wants to do that, it's got to put the money in to get the money out. And the Future Fund could only obtain funding from government asset sales and budget surpluses. There has not been any suggestion of a process to explicitly put aside a proportion of the budget each year. And as a consequence of the last 6 years, the budget is now in structural deficit and has to be rectified. So it's hard to see how a priority for putting another tranche of money in the Future Fund for another purpose would be possible in the near term. But the establishment of that fund was something I was very keen on and keen to play a role, and also keen to see the consequences of decisions in sovereign wealth funds around the world about asset allocations and how it affects the system.
Yes, I'm originally from Europe, but I've lived in Australia for the last 20 years. So maybe an outside perspective looking in. Australians tend to be quite conservative. Argentina and Australia were roughly the same GDP 20, 30 years ago, and you can see where Argentina went. But right now, there is an air in Australia that there's a worry. We haven't kept up in productivity. We're way down on that. We've had too much of a good thing. Mining industry went berserk, so LNG projects now are super expensive, super high costs. And we've got an issue that we've got so much infrastructure to do, but we don't have a real mechanism. Sir Rod Eddington has a list from here to Timbuktu, what we need to do infrastructure. We don't seem to be able to get to the next level of funding. And agriculture, we need to do much more. and again, they have a problem with funding. How dire do you think the situation is? How serious is it? And are we really in a bit of a jam? Do we have to really look for? Thank you.
Well, in respect to the financial system, it's very important that we don't try and conduct a centrally controlled financial system in an open market economy. Similarly, there are other aspects of the Australian system that need attention. We've done extraordinarily well by switching to become an open market economy with integrity. But we have an industrial relations system that was designed in 1903. Those two things do not go together. And a real challenge at the political level will be to encourage the community to understand why they don't go together. So that's one, I guess, structural flaw in the system. The other is that we have rule of law, single currency. Unlike Europe, we don't have a constitutional problem about that single currency. But we do have a set of arrangements on tax and funding between the Commonwealth and the states, which has some structural flaws. Because you mentioned infrastructure, the burden of infrastructure development in Australia falls on the states, not the Commonwealth. The only infrastructure the Commonwealth has is a few warships and a couple of tanks, and some American aircraft kit, But and the Commonwealth's not very good at running that, by the way. But I'm not doing an inquiry into that; it's too hard. The issue there is that were a state to develop infrastructure of significant economic benefit to that state, the payoff to that state would not go to that state under the tax system. So there are these distortions, but there's some very good signs on infrastructure. It's quite clear that the states will not be able to themselves fund infrastructure in the way they normally should. By the way, I'm a fan of state-funded public goods. It's the best model that any economy can have. But if they can't be funded and their development would increase productivity, then private sector should be brought in on an appropriate basis to do it. In Australia, I think it's worth looking at the model that Mike Baird, the Treasurer in New South Wales, has adopted. Usually, if a state wants to, in Australia, you mentioned the conservatism, if a state wants to sell an asset, a significant portion of the community complains that you shouldn't sell the family jewels. What Mike Baird has said is, if I can sell an asset, I will use that money directly to fund the state's development of a new asset. It is clearly evident to the community that that new asset is of value, a very important issue, and so he's getting buy-in gradually. But the potential list of asset sales in the states in Australia is huge, and if they were to hurry up and move on those asset sales with the Mike Baird model and develop more infrastructure, I think the payoff to productivity would be enormous. There's one further thing to mention about that. The infrastructure financing itself requires a deep capital market, but it also requires a benchmark backup on term funding. So for the Australian government to issue a 30-year bond would be enormously helpful. Unfortunately, one consequence, I mentioned the Fung Institute and the Basel III. one consequence of Basel III is to shorten the maturity transformation in the banking system. This is not helpful for infrastructure. And lastly, I was very impressed with what the Norwegians have done with infrastructure generally. They have published a set of transparent standards upon which these public goods need to be evaluated. You know, if you like a transparent set of accounting standards. This makes a huge difference. This takes away the opacity of project choice and gives a lot of confidence to the capital market coming in and supporting projects. So I think there's a good amount we can do, and I'm hoping we get some good submissions on the infrastructure front.
Mr. Murray, thank you for your presentation today. Could you comment, please, on your observations around the role that the superannuation system plays in the liquidity profile of the financial system in Australia?
Yes, I don't know whether that question's too hard to answer or embarrassing to answer. The superannuation system works on a defined contribution basis and choice of provider by the beneficiary, and mostly choice of asset allocation by the beneficiary according to a predetermined mix that the trustees give them to choose from. This has consequences and costs which are not in a good defined benefit system. There is less pooling of risk in this system. And the liquidity issue arises because if trustees know that beneficiaries can switch their asset allocation, they have to keep cash available to enable that switch to be performed smoothly. The other liquidity issue is that the superannuation system invests very heavily in equities, because a lot of those who don't make an election on asset allocation go to a default fund, which is usually a balanced fund at around 80-20 risk mix. Now those equities are invested in about, I could be wrong here, but roughly half domestically and half internationally. Now, to the extent that those funds hedge those international exposures, then I mentioned in answer to a question earlier, the commodity reliance in Australia and being a price taker, it means that the currency from time to time can swing noticeably. This sets up a liquidity risk for superannuation funds on settling hedges. And so there are some complications on liquidity that one mightn't have in a defined benefit system. We'll be anxious to see what the efficiency consequences of that is for the system, and if there's something or nothing should be done about it, it'll be on our mind.
Well, we're out of time, so please thank our speaker, David Murray.